Hello, dear friends and dear viewers. My name is Clive Thompson. I've been investing money for 50 odd years. I made a few mistakes. I've made a lot of mistakes actually in the past. I make much less now. And I've learned a lot of tips and tricks for making money in the stock market. And I'm here to help you make less mistakes and make more money in the stock market so you can prepare for your own financial future. This here is my son. He's 8 years old. And the reason he's with me is because he wants to learn about the stock market. And we're going to talk to him a little bit about his ideas for investing in a minute. But before we start, I'm just going to tell you what I'm talking about today. This is a lesson for complete beginners in stock market investing. So if you're not used to investing in stock markets, there's going to be lots of words which you've never heard of, which will teach you how to invest. If you're a veteran and you've been investing for many years, you're bound to still learn a few things. But here are a few words I will be using in this YouTube video. So I'll be using words like stocks, shares, equity, profit, dividends, capital gains, portfolios, brokers, banks, stock exchange, ticker symbol, market capitalization, price to earnings ratio, earnings per share, growth, dividend yield, bear markets, bull markets, exchange traded funds, real estate investment trusts, mutual funds, unit trusts, index funds, blue chip. We'll talk about blue chip stocks. We'll talk about buy and hold strategies and trading strategies, dollar cost averaging, diversification, and risk tolerance. Those were some of the words that we might use. Now, I wondered if my little boy has ever heard of any of these words. You've probably heard the words being spoken about. Whether you absorbed it or not, I don't know. Anything that rings a bell there?
Ticker symbol.
Yeah, what's a ticker symbol?
It's like a name for a company that holds like 3 or 4 characters.
So like International Business Machines would have IBM as the ticker symbol.
Yeah.
Or
For Nesquik it would be like NES.
Nestle would be NES, yes, or NVIDIA would be NVDA, for example. We might cut this video into 2 parts to keep it shorter, because I know people don't have a lot of tolerance. So I've tried to make 2 lots of 20 minutes, and so you might find part 1 and part 2 uploaded on different days. Feel free to watch them when you're ready. So let's talk about, first of all, the words stock, shares, and equities. They're all the same thing. If you own a stock, you also own, it's a share or an equity. So you can say I own a stock, or I own a share, or I own some equity in a company. It means that you own a share of somebody else's business, but now it's part of your business at the minute you buy shares in a stock, a share, or an equity. Now, do you know what a business is and why would we have a business? What's the purpose?
The purpose of having a business is to make money.
Yep. Can you think of a business? If you were going to do a business of your own, what would you do?
Okay,
I'll give you $1,000 to invest. What
Yeah.
do you with $1,000?
Let's say I buy 1,000 bricks, each one costing $1. I'm going to sell it to the construction builders for 2 times the price. That means $2 each.
So how much profit would you make?
1,000.
Wow. And you're going to do that just once and then it's finished, or what?
No. So I'm going to get some 10 friends to buy the bricks. Then I get 10 friends to carry the bricks to the construction builders. So I pay $10 to the people who help me buy the bricks, $50 to the people who help me carry the bricks.
So how much profit would you make? So you had to pay some friends, the first lot of friends $10 each, $100, and the second lot of friends $50 each, make $500. So you've got 100 plus 500 of expenses.
600?
So how much profit would be left?
400.
That's right. So what would you do that then? You've got your original capital of 1,000 back, and you've got 400 of profit.
And then I would pay 200 to you because you gave me the 1,000 at the beginning.
Excellent. That's called a dividend.
Yes.
As
And
a
now-
shareholder, I'd get a dividend.
And now my profit is $200.
That's right. You've got 200 left, which you can reinvest in more bricks. So you buy 1,200 bricks this time and do it again.
I don't have to do anything. I just sit while all my friends do the work, So at the end, I just pay them.
What a capitalist. You sit on your bottom while everybody else works for you and pays you and makes a profit for you. That's excellent. And of course, I'm going to be very happy with that because I'm going to be collecting the dividends too. And of course, as your business grows, as you sell more and more bricks, the share price, your shares will go up in price. That's called a capital gain. So that's one of the reasons you want to invest in the stock market, because you're investing in someone else's business. You don't have to do anything. You're just supplying some capital to the market, and effectively the people who work for that company in part are working for you, and you're going to receive over time a share of the profits in the form of what's called a dividend. Now, it depends on the company, but some companies don't pay any dividends at all, but most do. And in some regions they pay one dividend a year. For example, Swiss companies tend to pay one dividend a year. American companies tend to pay 4 dividends a year. UK companies tend to pay 2 dividends a year, and it can vary according to the country. But broadly speaking, wherever you invest in the world, you'll get 1 or more dividends per year for the companies you invested in. And if those companies are doing well, if they're increasing the profits, you can expect the dividend to increase. So the reason for having a portfolio is to be diversified, or diversification, so you don't have all the eggs in one basket. Have you ever heard that expression?
No.
Okay, if you've got all the eggs in the one basket and you drop it, all the eggs will break. So if you carry 2 baskets and drop one, you've still got some which are left. Same thing with companies. When you invest in companies, they don't all succeed. So by investing in lots of different companies, you're diversifying and hoping that some of them will succeed and some won't. And here's tip number 1. The most money you can lose when you invest in a company is 100% of what you paid. Of course, that's really bad.
Why don't you hope that they all win?
Well, you do hope they all win, but realistically speaking, not every company goes up. Some go bust. Go bust means they lose all the money and they're worthless. That's very, very unusual, but it can happen. But the worst that can happen, if you invested some money into a company, it goes to nothing, you've lost 100% of your investment. But if you have a company which you've invested in and does really well, how much is the maximum profit you can make? Any idea?
No.
Infinity. There's no limit to how much profit you make. So if you have half your companies go down and half your companies go up, even if one of those companies which went down goes down 100%, you'll hopefully have more than one company over time going up by a lot more than 100%. So, for example, in your case, in year 1, you made $200 profit. In year 2, you might make $400 profit. In year 3, you make $600 profit. So your share price should go up. And after a while, it'll hopefully have gone up a lot more than 100%. How do you buy shares? If you haven't bought shares before, you need to contact your bank or a stockbroker, or you might have an application on your phone to do it. But in broad terms, the way you do it is you send the bank or the broker where you want to buy and sell things, you send them some of your money, and then online, typically online, of course you can do it verbally as well, but typically online these days, you type in what you want to buy or sell, and the bank or the broker will do it for you. And have you got any idea where they buy the shares?
In the stock market.
On the stock market, yes. So the bank, when you give the order to the bank, it'll immediately buy the shares you want on the stock market. And the stock market is a place where there are hundreds of thousands, if not millions of people, all buying and selling at the same time. And as they buy and sell, the price of your shares will go up and down. So if you buy shares in the stock market, the price tomorrow, in fact, the price in 5 minutes might be different from the price you just paid now. So if you find a company which is worth more than the price on the stock market, you've got a bargain. If you find a company which is worth less than what the price is on the stock market, well, just don't buy it. I mean, there are people who can go short, which means sell something they don't own, hoping to buy it back later. But don't do that. Just don't buy the things which are worth less than you're paying. But you want to buy things for less than they're actually worth. Do you understand that point?
Yes, a profit.
So if you were going to make money on the stock market, how would you go about it?
I would sell high, buy low.
Sell high, buy low. Well, he's understood everything. But usually you buy first before you sell.
Oh yeah.
So you buy low, sell high. what's market capitalization? Market capitalization is the size of the company as valued by the stock market. And the way you work out market capitalization, you don't have to work it out because it's done for you on almost every financial website. But the way you work out the market capitalization is it's the number of shares which are in existence multiplied by today's share price. So tomorrow, when the share price is different, the market capitalization will be different. So number of shares times share price gives you the market capitalization. So there are micro, very small companies, there's medium-sized companies, there's big companies, and there's mega cap companies. So there's lots of different classifications of what are big, large, small companies, but mega cap companies would be the companies which are in the hundreds of billions, if not in some cases the trillions. Companies like Nvidia has, I think it's $3 trillion. That's a mega cap. Then you've got the large caps. Large cap companies are companies where the market capitalization is 50 billion or above. If you want to play safe and you don't know what you're doing and you're a beginner in the stock market, my advice is to stick with the very large companies. That's the large cap companies valued at $50 billion or more by the stock market. Those are the companies with the market capitalization 50 billion or more. You can go a bit lower, but the more you know about the stock market, the more you can venture into those lesser known companies, smaller companies, provided you've done your research to see what they're worth. Let's talk about price earnings ratio. Have you ever heard those words before?
Price ratio.
Okay, so the price is the share price of the stock, and the earnings are what it earns per share. So in your example, all the stock was worth $1,000. That was what I invested, and you earned a profit of $200. So if I was to work out the price earnings ratio of your company, it would be the $1,000 share price divided by the $200 of earnings, that's the profit, which would give me a price earnings ratio of 5. So what's a low and attractive price earnings ratio? What's an unattractive price earnings ratio? Well, the lower the price earnings ratio, the better in general, but subject to another point I'm going to make, and that is subject to the growth. But if all things were equal, you want to buy a company with the lowest price earnings ratio, but by low, share price. Now, I said that's subject to something I was going to talk about, which is growth. If you have a high growth in the earnings per share and the sales of the company, then it's definitely worth paying a higher price earnings ratio. Because if you think about it, let's say you buy a company with a low price earnings ratio and typically there's no growth. So this year the share price will be the same, next year it'll be the same, the year after it'll be the same. It's not going to change much because there's no growth in the earnings. So you'll have, whilst you get your nice dividends, you won't be getting your capital growth and you'll be standing still. Whereas if you buy, so that might be a company with a price earnings ratio of 5 or 10, whereas if you buy a company with a higher price earnings ratio and you've checked into the numbers and you find it's got some growth, that could be a better deal. So let's say you found a company with a price earnings ratio of 15 times, that's the earnings of 15 times, or the share price is 15 times the earnings. So price earnings ratio is 15, but it's growing by 10% a year. They're growing the sales or they're growing the earnings by 10% a year. So in this case, you're maybe not getting quite as high a dividend, but you're getting a capital growth because the share price should be rising as the earnings are rising. So if the earnings are rising by, let's say, 10% a year, you might be missing out on a dividend of 6% and only getting 2%, so you lost 4%. But if the earnings are going up by 10%, the share price probably will be going up by 10% a year over time. Won't be as smooth as that because it's ups and downs, but over time it'll be up by 10%. So you give up the 4% of dividend in order to make the 10% of extra 10% of capital gain. So price earnings ratio is a relative thing. You don't want to look at that in isolation. You want to look at it in the context of how fast the company is going to grow. And in that respect, all things being equal, the faster the company is growing, the better it is. Dividend yield, I did mention that word a couple of times. When a company makes a profit, it shares part of that profit with you. It's called the dividend. You might want to know how much that dividend is as a percentage of the share price that you paid, and that's called the dividend yield. So let's say you paid $100 for the shares, $100 per share, and it's paying a dividend of $2. What's the dividend yield? So if you buy a share for $100 and it pays you $2 in dividends, you're earning 2%. If you buy the same share for $200 and it pays $2 in dividends, your dividend yield is 2 divided by 200, so it's only 1%. So here's another thing. All things being equal, the better the dividend yield, or the higher the dividend yield, the better it is, at least from your perspective. But some people might disagree, and they say, well, actually, I want the company to reinvest the dividend in the business to grow the business faster, so I actually would prefer to get a low dividend or no dividend, so that all the earnings are reinvested so I can get maximum growth. That's a personal preference. If you're an older person like myself who's retired, you probably want dividends because you've got to eat something, and that's my case. So I tend to invest in companies which have got a reasonable dividend, and I can find growth with companies with reasonable dividends. Now, here's a word you may not know. You never heard of bull markets and bear markets, have you?
No.
Bull markets are when stocks are going
Up.
and bear markets are
Down.
Yes. A bear market is when stocks are going down. Now, we can never know in advance whether we're going to see a bull market or a bear market next, but we can know where we are. So if stocks are generally rising, you can say we are in a bull market, and throughout most of history, stocks have been in a bull market punctuated by fairly short bear markets. There have been long ones back from 1929. A bear market is officially described as when share prices are 20% below their peak. So when shares are 20% below their peak, that's a bear market. And of course, people kind of say, when you're in a bear market, it continues until it doesn't. And when you're in a bull market, it continues until it doesn't. Here's a few words you might come across when you're investing in stocks and shares. First of all, exchange traded funds, or ETFs. Exchange traded funds are funds which they're basically a fund of lots of different investments. So a collection of stocks, typically, could be bonds, but we'll talk about stocks today. It's a collection of stocks in one investment. If you buy an exchange traded fund, you're basically buying this basket of stocks with one transaction. That's good for some people because you only have to pay one brokerage fee. There's a special type of exchange traded fund called an index fund. So an index fund tracks an index like the S&P 500 or the CAC 40, that's a CAC 40 in France, or the DAX index in Germany, or the FTSE 100 in the UK, or the Hang Seng index in Hong Kong, and so on. So wherever you look in the world, each country has its own stock exchange index, and there will be, for each index, or each major index, there'll be an exchange traded fund, which is an index fund tracking that index. So if you're worried that your broker or your bank may not be able to pick stocks as well as the index, just buy the index through an ETF and do what the index does. Now, I prefer to buy direct stocks myself. I prefer to study and see which ones are the good ones, and there's hundreds of ways to do that. Everyone's got their own theory. I've read them all in the books, and I know what I like. Well, I don't like one over the other. I like them all, so I prefer to buy direct stocks. But if you don't know what stocks to pick, or you haven't got the time, an index fund would be a great investment, or an ETF, which may or may not track an index. So now we're halfway through the video. We're going to do a short break now. We're going to cut this off, and so like, comment and subscribe. I'll reply to your comments at least for the next 7 days, and you'll see part 2 of this video with the rest of it coming up in the next day or two. So thank you very much, everybody, and goodbye.
Bye-bye.